Hi, my name is Jun Chen. This video is created to explain how to use a hidden Markov model to detect market regimes. This research is entirely data-driven, so we always start with data. First, we observe financial data in the market over time, and we want to know what regime the market was in. With the observed financial data, we summarize the transaction prices with trends in DC. For each trend, we can measure the DC indicator, TMV and T. Then we can compute the return R of each trend. To detect market regime with the hidden Markov model, we observe the return of each trend, the Ys. We assume that this return reflects the hidden state of the market. We further assume that there are two types of hidden state, either regime 1 or regime 2. Each state emits a return from a probability distribution. This is called the emission probabilities. The emission probability can be any distribution conditioned on the current hidden state. Unfortunately, we cannot observe the hidden state directly, nor do we know the emission probabilities. We further assume that the transition of states is a Markov process. Without this assumption, there is too little knowledge about the process for analysis. As with a first-order Markov chain, the probability of a particular state depends only on the previous state. This means the state xt depends solely on the state xt-1. For example, if the previous state was regime 1, then the probability of the current state being in regime 1 and regime 2 is P11 and P12 respectively. P11 is 1 minus P12. So given a two-state problem, we only have to learn two probabilities, P12 and P21. We call this the transition function. To summarize, for the observed returns, we want to learn the sequence of hidden states as well as the emission probabilities. We want to find a sequence of hidden states and the emission probabilities that maximally fit the observed data. For this purpose, we use the package called DeepMix S4, which implements the hidden Markov model in R programming language. It uses the iterative expectation maximization algorithm by default to train both the transition probabilities and the emission probabilities of the hidden Markov model. This diagram shows the emission probabilities learned by the hidden Markov model from the GBP/USD forex market based on second-by-second data. It shows that the regime is not simply classified by the R value. This diagram shows the position of each trend on the normalized T and TMV space. As we can see, there is an overlap between two regimes, so it would be hard to draw a line in the T and TMV space to determine what regime the market is in, and this is why we need the hidden Markov model to detect market regimes. And this is all for today. Thank you for listening.